Okay, so let's get started. We're going to do this problem. Okay. 1 year ago, your company purchased a machine used in manufacturing for whatever. You have learned that new machine is available that offers many advantages. You can purchase it for this amount. Okay. It will be depreciated. Okay, cool. And no salvage value. So it will depreciate to 0, and the book value is going to be 0 after 10 years. You expect the new machine will produce a gross margin of this per year. Okay, cool. The current machine is expected to give a gross margin of 20. Okay. The current machine is being depreciated over 11 years, no salvage value, and they gave you a per year value of the current machine depreciation. Okay. The market value today of the current machine is this. So you're going to sell it. If you want to sell it today, you'll sell it at 50,000. Your company's tax rate, 25%, cost of opportunity. Okay, cool. This is fine. The first thing that you have to remember when you're doing these kind of questions is what is the change? So the change and difference in everything. Okay, another thing is if you're clear with how to do like income statement. So if you're doing income statement, remember it's revenue minus cost of goods sold. You're gonna get like a gross margin, minus SGA, and then you're gonna get EBITDA minus depreciation. You'd get EBIT minus which one? Tax or interest. Interest goes first. So minus interest, you get EBT, and then you tax it, and then you're going to get your net income. When you do tax, when I say like tax something, that means you're going to multiply it with 1 minus the tax rate. So in this case, you're going to multiply EBT with 75%. And we're gonna do that anyway. So we're gonna take the difference of everything. Okay. All right. Let's do for like. It looks like it's like 10 years. So let's do like a timeline. 2. I don't know how visible this is. 3. And then just drag it. Okay, perfect. 0 as well. All right. And we're gonna always do like difference. Okay. So let's say, for example, you buy the machine. So buy the new machine. You're gonna buy it at 150. So it's gonna be negative 150,000. That's fine, right? Okay. Cool. And if you, let's say, for example, sell the machine, we could do sell it later, maybe. But if you had done sell, then what would that look like? Let's think about it. So if you sell the machine today, okay, so let's just sell machine. If you sell it today, you have to sell it at 50,000. Okay. What is the book value today? The book value is definitely, say it is 1100. That is how much you purchased it by last year. And then 1 year, how much of depreciation did you lose? So they told you that's gonna be 10,000. So minus it's 10,000. So 100,000. That's the book value. So it's book value. Just gonna like draw on this. Okay, and this one is the market value. Okay. So did you make a profit? You didn't. You actually sold it below its book value, right? So if you made any difference that you made, that's not going to be like, that's not a profit you made, right? You made a loss. If you made a loss, then you're gonna tax that amount, and that's gonna become like your tax premium or tax break, right? So not how visible, so let's focus on this. There you go. So 0.25, that's your tax rate, times in a bracket, book value minus what you sold it at. Okay. And this is going to be added to like how much you got by selling it. So you sold it at this plus the tax premium. So this is the amount you're gonna get. Okay. So sell old machine. Basically going to be this amount. So just gonna refer it to here. Okay. Cool. All right. Now we're gonna do some income statement stuff. All right. Okay. All right. So we're gonna do change. Always change. So change in revenue, or like change in cost of goods sold, which would give to like change in gross margin, right? Now, we don't know what's going to be the change in revenue or cost of goods sold. No idea. But they did give us what would be the change in gross margin, because they said that with the new machine, you're going to do a gross margin of like 40,000, whereas with the old machine, it's going to be 20, right? So that means, what is the change? The change is going to be 20,000. If that makes sense. Okay, and that's going to be true for like all 10 years. Okay. And then what do? You minus the SGA, which they don't have it here, so maybe there's no change in SGA, but there's gonna be a change in depreciation, right? So change in depreciation. Because you bought the new machine, any kind of extra depreciation that you have because of the new machine, that's going to be like a change in depreciation, right? So let's do that. So your new machine for 10 years, so each year your new machine is going to depreciate by this amount, right? And how is it different? How much is it different from like the old depreciation? So old depreciation was 10,000. It looks like it's gonna have like a 5,000 extra depreciation because of your new machine, right? So the change in depreciation is going to be 5,000. Okay. And then what you do, you're gonna find change in EBIT, right? Because you're gonna subtract depreciation. So if you do that, so it's gross margin minus okay, that's your change in EBIT. Now what do? You don't have interest, so what would be the change in net income? That's just you're gonna just tax it, right? So this times 0.75. So it's gonna be your change in net income, right? Now to find free cash flows, what do? You have to add back depreciation, remember? So you add it back. So you add this to change in depreciation, sorry. This one plus this. Right. So it's going to give you the value that you need, the cash flows during these years. Just like make it prominent. All right, perfect. Cool. Now we have that value. And we also probably should find out what's going to happen in year 0, which is this plus. So you're going to buy the new machine, sell the old machine. This is what's going to happen. Year 0 cash flow. That's clear. All right. Do we do everything? Yes. I would say yes. Okay. Great. Now we're gonna very simply find the NPV. So let's do that. NPV rate, they said it's going to be 10% cost capital. Remember, we take all the values from 1 to 10, but not year 0. Year 0 is going to be separate, plus year 0. We don't want it in percentage. Okay. What's the value we get? And that's a positive value. So should you buy the machine? And I guess you should. Okay, just want to check that that matches. 1, 2, 3, 4, 9.22. 2, 3, 4, 9.22. Yep. Fantastic. All right. Was there any? Yes, there was a profit. Okay, cool. All right, so that's this one. Hope that helps. We're always going to do change. So know how to do the income statement and then always do like, okay, what's going to be the change in this because of us buying the machine, because of us doing a project? What's going to be the change in revenue? It's going to be the change in depreciation, find that. And then if you get an NPV of like a positive number, then I'm like, okay, it's worth it. Okay. All right, so that's this one.